Hi everyone, welcome to today's video. So markets are hitting an all-time high and you might be wondering, yeah, should we invest? Should we sell? What is it that we should do? So I thought that I will present commentary of three big investors in India. Interestingly, all three of them are giving very different viewpoints about the market. So it is better for us to understand all these different perspectives and then design our own investing style. So that is the spirit with which I'll be shooting this video. And the three investors that I'll be speaking about would be Mr. Vijay Kedia, Mr. Saurav Mukherjee, and Mr. Ajay Shrivastava. All three of them have given different viewpoints, different style. Important point to note is that when it comes to big investors, they do some kind of hedging for their portfolio. For example, they might take some trades in the F&O market. They might be doing profit booking regularly. They might have better cash flows management. All these points are not usually talked about during our TV interview and we miss these points. So as retail investors, it's very important for us to hedge our risk, and one of the easiest ways we can hedge our risk is by investing in the bond market. This is not a sponsored video. You will see an affiliate link of InCred Money, which is a bond investing platform. These type of affiliate links allow me to run free financial programs. For example, I'm running one financial literacy program for kids in Delhi on 25th of June. The seats are fully booked, but that event will be made free. And I will be uploading that also on our Wisdom Hatch website. You can take a look. So if you have young kids, young relatives, do share that recording with them for sure. So that is a program that I'm doing. There is a lot of cost involved with it in terms of uploading it, maintaining the tech backend of it. So therefore, I've decided that whatever affiliate incomes I'll make, I will use that income to support such programs. In fact, if you use the affiliate links in the description and comment box, the bond offering that InCred Money will come with, you will get an additional 0.5% on it if you use the links in the description and comment box. So do go and check it out. And now back to the main video. So let's first and foremost speak about Mr. Saurav Mukherjee, his general investing style, and what are specific sectors and stocks that he's bullish on. So I will do stock specific discussion also, and I will give you my commentary on it. So first and foremost point about Mr. Saurav Mukherjee is that he is a growth investor. Now, what is the meaning of growth investor? So for that, let me pick the example of Divi's Lab and explain that philosophy. Now, growth investing simply means that you buy fundamentally good companies and you do not worry too much about the price of the stock. For example, this is Divi's Lab. Now, if you check Divi's Lab and if you check the fundamentals of the company, then what you would notice is that ROCE is 19.3%. It is a zero debt company, and the revenues, profits of the company are also growing, right? So this is a good company, net. Now, if the management is clean, other things are in order, no red flags are there, then we could categorize it as a fundamentally strong company. So Mr. Saurav Mukherjee's viewpoint generally while investing is, at least to what I could decode, is that he will pick clean companies. He will pick companies where ROCE is growing. He himself says that I look for companies where the free cash flow is growing at 15-20%. So those are his investment parameters, and it fits with a classic growth investor. Now that's the good part, that you end up picking clean companies, but the bad part is that you end up picking them at whatever prices. For example, as far as I know, Mr. Mukherjee was buying Divi's Lab here also, and he might be buying a lot of it, and the stock price corrected by a lot. It corrected by 40-45 odd %. Now same thing happened with HDFC EMC, same thing happened with TCS. In fact, if you would have been watching my videos, you would categorically know that I was not buying TCS unless it fell to like 3,000. Then I purchased it in bulk, swung traded and sold it like around 33, something like that, right? And I was out of the stock. Now, when Nifty fell again, I had purchased bulk Nifty. I'm just sitting on it. That's it, right? So what I'm trying to tell you is not that, you know what, my investing style is better or my investing style is not better, vagera. That is not what I'm trying to do. What I'm simply trying to tell you is that growth investing has certain pros and it also has a lot of cons. That is the simple message that you need to take out of it. And it has reflected in Mr. Mukherjee's performance also. For example, his PMS scheme performed really badly in the year 2022. So all these points you should know. And now with that said, let me take you to 5 specific stocks that he is somewhat bullish about, and I will give you my commentary on that. So he spoke about 5 key stocks. One was Metropolis Health, one was Divi's Lab, one was Dr. Lal PathLab, and then he also ended up speaking about Titan and Alkyl Amines. So let me give you a very quick perspective there. Which of these would I be holding? Which of them I might be buying more? All that, right? So let me quickly take you through first and foremost these 3 stocks: Metro Health, Divi's Lab, Dr. Lal PathLab. First key point that you need to understand is that, see, these are correlated stocks. What is the meaning of correlated stocks? That, for example, it is like you buying TCS, Infosys also, Wipro also. These three stocks will be correlated. Do they do exactly the same work? The answer is no, but the correlation will be high. That in case you end up investing, let's say 10 lakh rupees each in each of these three stocks, and if the IT industry falls, your portfolio will fall like crazy. Same thing might happen with these three stocks. That these three stocks, Metro Health, Divi's Lab, Dr. Lal PathLab, are somewhat correlated stocks. So please note that because Mr. Mukherjee is speaking about these stocks, don't go and invest like crazy amount of money in each of these three stocks if it does not make sense to your portfolio. Repeat, if it does not make sense to your portfolio. Please note that, very, very important point. Now, come to the second point that, okay, what about like these three stocks? Can you do some commentary? Okay, so let's start with Divi's Lab only. So Divi's Lab, basically what it does is that it manufactures API and it exports. This is the classification of exports. So you can look at its exports to Europe, US, bunch of other countries. What are APIs? APIs are called as active pharmaceutical ingredient. These are raw material from which eventual medicines are made, right? So just for the purpose of simplicity. Now, the business depends quite extensively on exports. We are unfortunately in the election year or almost in the election year, not only in India, but 2024, we will see elections at a bunch of different places across the world. During election periods is when the nationalistic sentiments get stirred up. Every country starts saying that, you know what, Make in India is the best, or Make in Russia is the best, or Make in China is the best, or Make in US is the best. And a bit of import-export restrictions are put. So as a result, export-oriented businesses tend to suffer, right, during such times. This is something that might happen with Divi's Lab also. This is the primary risk with the stock. Is it a fundamentally good company? Solid company? Nothing wrong with the company per se. Valuations are also fine, right? For example, if you take a look, it has already crashed by 40-45%, right? From here to here, it has started to go up right here. Will I be buying more? The answer is no, right? So if I take a look at Divi's Lab, I already have it in my portfolio a little bit, but I'm not going to buy it unless I get it at even more massive discount. Why is that the case? Because now you might say that, you know what, Akshat, this is already at a discount. Why are you not buying it? Very simple, because I see better market opportunities at this juncture, which are relatively less risky for me, where I can do domestic consumption play. For example, if I take a look at cards company, or if I take a look at insurance company. For example, many of you might be watching my videos for a while and you would know that I've been very bullish on HDFC Life. So that has started to give a massive run up. So I'm more bullish on these themes at this juncture. This does not make Divi's Lab a bad stock for me, but I'm sitting somewhere in the middle where I see better market opportunities right now. So I would rather put new money in something like this. This is my personal belief, my personal opinion. Pharma stocks are going to do well subsequently, no doubt about that. But if I take a look at PE, it's not as if that I'm getting like very cheap PE at this juncture. This is not even like pre-COVID PE at which I'm getting. So it's not as if that these stocks have become like relatively very less expensive. I had already built some positions in it. I will continue to hold it. Someday they are going to go up if I take 1-2 year viewpoint. But putting in new money, I will refrain from that. Same commentary applies to Dr. Lal PathLab, that I had purchased it when it has fallen quite a bit, built my position. Now I'm holding tight, little bit of loss here and there, but it's not as if that, you know what, my positions are such that, you know, I will start fretting. So what about Metro Health? So this is a slightly different company. Let me share some quick data points around it. So you'll see that debt to equity is 27%. So debt is fairly high. It is a mid to small cap type of a company. If you take a look at its fundamentals, right, what you will see is that, see, sales growth has happened, but profit growth has not happened proportionally. For example, 2019 data, if you see, the sales was at 761, profit was 124. But if you check 2022, 2023, sales have gone up massively, but has the profits gone up proportionally? The answer is no. So this looks like a debt fueled growth. I typically avoid such companies unless there is a very clear perspective that there is a very clear product market fit. So I'm not right now investing in it. But having said this, small cap, mid cap का ज़माना चल रहा है, right? And small cap, mid cap stocks are going to perform really well. So maybe Metro Health will perform quite good. Now, since I've already built a lot of positions in other small cap, mid cap companies in a more diversified manner, ऐसी कोई need नहीं है that I have to go and invest my money in like Metro Health and take like crazy bets on it without any substantial data. So for now, I'm not buying Metro Health. So now let me talk about two non-pharma picks that Mr. Saurav Mukherjee gave. So one was Alkylamines. He's already an investor in it. It's a solid company. So I had a bit of it. I sold it. I'm looking to re-enter it. So will I be buying it at this juncture? Let me quickly discuss that. See, it's a solid company. I don't even need to take you to profit margins and all that stuff. You guys are smart enough. Now, very quickly, let me comment on the valuations. The valuation seems okay at this juncture. I don't think that there is anything majorly off. The stock has already corrected by 45%. It's a specialty chemicals play, and the recent numbers are also both in terms of profits and revenue. So net, it's a good company, no doubt about that. I will not get into massive details here. What I will simply leave you with is the fact that buy this company only when it is around its 200 DMA. So this is 200 DMA, right? If you're looking to buy now, build new positions on it, it's probably an okay time. This was a great time to build positions, no doubt about that. But now is probably an okay time. I will wait. I'm not going to build my positions immediately on something like alkylamines. I explained you earlier that I see better opportunities in markets elsewhere. So I don't need to necessarily get into specialty chemicals space out of now. But in case I get like a bulk buying opportunity, I might do it subsequently in the future. So that is my commentary on alkylamines. But if you want a diversification, if your portfolio is such too much finance ho chuka hai, too much IT is there, all that stuff, want to build position in specialty chemicals, good stock. I think valuations are also sensible at this juncture. Unlikely that you're going to suffer like massive losses from this juncture. At least it looks like, right? Now comes the final point that Mr. Saurabh Mukherjee spoke about. So this was regarding Titan. Now, Titan is a very interesting story. I have gotten so many queries that should we buy Titan? Should we not buy Titan? So let me quickly present my analysis there. See, Titan is fundamentally a very good company. No problem there. But here is the problem, right? The problem is the valuation and the classic growth investing theory. If you are investing in Titan here, then you must have a very clear understanding why Titan will keep on going up in prices at a fairly good rate. Okay, so for this, you need to know a little bit of history. Why did the Titan's prices go up recently? One was the increase in gold. Now, what does gold prices have to do with Titan? Okay, so Titan is like jewelry maker, watchmaker. It holds a lot of gold, and the life cycle of gold is fairly big. For example, if you are looking to buy a Titan watch in 2023, then in order to make that watch, Titan would have to start the process from 2021. It will have to procure gold. It will have to process gold, make watch, deliver it, distribute it, market it, and then finally you will get to buy it after 1.5 to 2 years. So there is a fairly long cycle that the gold procurement for whatever you are seeing now would have been done in 2021, and that is reflecting in 2023. And how much has the gold prices gone up by in the last 2 years? At quite an aggressive pace. Gold cycles are fairly long term in nature. They take like 10 years to transpire. So please understand that because a bull run has happened in gold, plus the fact that stock market bull run is somewhat happening right now, it's very unlikely that gold is also going to run or continue to run at the same pace as it has over the last 1.5 years. And this will definitely slow down the growth of Titan. This is point one. Your second question would be that, okay, koi baat nahi, gold prices are not going up. Maybe they will be able to increase the product prices and increase the number of units sold. Yes, that might very well happen, but price rise in Titan products has already happened quite aggressively over the last 1.5 to 2 years. Why? Because again, the price of gold went up. So their inventory also benefited and their pricing strategy also benefited. Because let's say they had procured gold at, let's say, 100 rupees a unit in 2021, right? Now, at the time of selling it, what is the value of that asset or the value that they're holding? For example, they bought like, let's say 1000 ton of gold. Okay, hypothetically speaking, I'm picking like simpler examples. 500 ने process करके बेच दिया, right? 500 they are left with. So this also is valued at 2023 prices, right? So that's one benefit. Second is that the 500 units that they have processed for gold, they have made watch out of it. For that also, they are going to increase the price proportionally, right? It's not as if that you're going to get like gold watch at lower rates compared to what the raw gold prices are. So I don't think that the prices are going to go up quite aggressively, at least for the next 1-2 years. But see, very recently, there was a gold price play, there was a price play, there was a quantity play. All three benefited Titan. But going forward, Titan is likely to benefit only from Q play, not the other two things, at least for a short period. So I'm not going to invest my money unless I get this stock at below its 200-day moving average. अब आप बोलोगे कि okay, आपकी गाड़ी छूट जाएगी, you will not be able to invest in this ever. let it be. I'm not bothered, right? So there are enough opportunities in the market. So I will probably catch those fishes rather than running after this. So that is my perspective. Important points that you need to take away from Mr. Saurav Mukherjee's commentary is that he is fully invested in the market, 100%. He's buying more. He is bullish about the stocks that he had already talked about. And it looks like that he will continue to make investments in all of these stocks. So that is what I could get from his commentary. I had explained you his pros and cons. Now you make a call as per your understanding. So now let's move on to the second investor, which is Mr. Ajay Shrivastava. He's not very active on social media, vagera, so you might not know about him. So here is his very quick background. So he is a graduate from IIM Bangalore. He had investment banking experience. He runs a consulting firm right now, has a good portfolio, and he has presented a slightly negative commentary. So let me first read out his 3-4 statements. First statement is that reality is uglier than what screens are showing. Number 2, markets have run ahead of its fundamentals at this point. Specialty chemicals PE has gone up to 250, 260. All valid concerns, and this is absolutely true. So his eventual piece of advice was that, you know what, investors should have a little bit of cash positions. And he's not fully invested in the market. He's building his cash positions. So that is something that investors should consider approaching as well. There are specific sectors where he is bullish. There are specific sectors where he is bearish. So I'll explain those viewpoints also. But very quickly, let me cover the point about building cash positions, because this is one way in which big investors hedge their portfolio. See, there are 2 types of investors in the market. One would be your typical mutual fund investors. SIP chala do. Every month we are going to put like 10,000 rupees and, you know, X amount of rupees, buy and forget, never book profit. So this is one set of investors. Okay. They are like buy and forget type. They don't make huge amount of money, to be honest, right? Compared to second set of slightly more intelligent investors, which act as per opportunities. Now, how can you act as per opportunities? Well, you will be able to do it if you have cash flows. So let me give you my example. So let's say hypothetically, what I do right now in the market is that I will be roughly 100% invested in the market. Okay. Now, every month, if I'm making a cash flow of 5 lakh, 5 lakh, 5 lakh, right? Then even if the market goes down, I can plug this cash flow here and I will be able to downward average it. So this allows me to take advantage of more opportunities. So when people give advice that, you know what, you should be away from the market, or you should be 80% invested or 20% invested, it all comes down to one single factor, which is cash flow. What is your cash flow like? If you have a good cash flow, then you can be 100% invested in the market right now. For example, I am almost 100% invested in the market right now, with the understanding that, you know what, my cash flows are clear. I will be able to make new money and plow it back in case the opportunities arises. If you are of the view that I'm not going to get a lot of cash flows in the next few months, then probably it makes sense to be 85-90% invested. Keep 10% money handy. This 10% money should always be handy with you if you don't have cash flows. I hope I was able to communicate this point. So this is a fairly important risk mitigation point that is adopted by a lot of big investors. Okay, so very quickly coming back to Mr. Ajay Shrivastava, what is he bullish and bearish about? So let me take you through that. So he is bullish about all these different themes. The first theme he's bullish about is hotels, then airlines, then defense, infrastructure, new age companies. Do I agree? No, right? Why? So think about it this way, and I'll explain you the economics here. So it's all a government money spending game, right? So government money spending game. For example, if the government increases its expenditure over the next 1.5 years, which it is likely to because it's an election year, then of course, all these industries will go up. No doubt about that. But again, what ends up happening here is that all these bets for you are highly concentrated bets. For example, if you're investing in real estate also, if you're investing in hotel companies also, you're buying a flat also, you are buying in defense also, then what is that single factor you're betting on? Government spending. Now, if it does not meet the market expectation, all these sectors are not going to rally, and you might end up having a very concentrated portfolio, and you might end up taking a lot of hit. So please realize that. In my case, I'm not investing anything in like real estate companies. Why? Because I directly invest in real estate. I've been doing it for the last 1.5 years. I'm already sitting on like 20% profits on some of my real estate investments in less than a year. Why is that? Because it was a great time to swing the real estate in a way. I have no intention of selling it. It was a good cycle for me, so I purchased it. I identify really good investment opportunities and I plan on holding that real estate. For me, that's a cash flow game. That's not a trading game. So anyways, coming here, basically what you would be doing in case you end up investing investing in these themes is that you would end up exposing your portfolio a lot to infrastructure, which is not a very sensible move. Little bit if you want to do it, but don't go super crazy in terms of these individual bets. Another way of thinking about it is that if the capital expenditure picks up, then banks are also going to disburse more loans. That will make it profitable. So if you want to lower your risk, then probably picking undervalued banks might make more sense. Which are undervalued banks right now? I will create a separate list on member community tab of YouTube. If you are a serious investor, you could consider joining it. I explain all the points fundamentally there, write out everything and give very timely information. So with that said, let me explain what he's bearish about and add my commentary on that. So he's bearish about low-end retail. He is generally, bearish about retail companies, fertilizer, commodities. So commodities 100%, I had already sort of said last year that I had sold all my commodity stocks. Commodity is a cycle. Gold is the only commodity that is somewhat performing still, but all the other commodities are not. They are cooling off, right? So no point here, right? Low-end retail, I completely agree that when it comes to these signaling products, for example, when you own an iPhone, you will flaunt it. When you own a Mac, you might flaunt it. But probably if you own a Redmi or a Dell, you might not flaunt it. So we are quickly reaching that society which is status driven. So low-end retail generally from a long-term perspective might not be a very sensible move as long-term investors. I'll not commentate here, and this I don't know, to be honest. So I'm just letting you know, right? So from this perspective, I don't know, but the key takeaway from Mr. Ajay Srivastav's commentary is that be prepared for a market fall. That can happen, and I 100% agree with me. For me, the way I am mitigating that is by managing my cash flows. That is something that I am looking at. You can also do bond investing, as I had previously said. That's one way of mitigating risk. And probably I will come up with a separate video on risk hedging strategy. Now let's move on to the third investor and my favorite investor right now, which is Mr. Vijay Kedia. I absolutely love the person simply because he's like, enjoying life, singing songs, whatnot. So he's like, mast maula type. So I really love that attitude about his style of living life more than anything else. That's one. Second key thing, if you are trying to emulate Mr. Vijay Kedia style, please understand what type of an investor he is. He is a high risk, high reward type of an investor. Now, what is the meaning of high risk, high reward type of an investor? So for that, you need to understand the VC game or venture capitalist game. Now, what a VC does is that, for example, a VC would go and invest 1 lakh rupee in 100 companies with the understanding that 80 of them are going to die. But the 20 that remains, they are going to 10x in size. So if you run the math, you will see that 80 company khatam, 20 go by 10. So that gives me how much? 200. So my 100 unit of investments becomes 200 units of investment despite 80 companies dying. So that is Mr. Vijay Kedia's style of investing as per my understanding. What he does is that he buys a lot of mid cap, small cap companies. He has categorically said, I buy like companies that are like, just starting out, so to say. They should have the hunger to grow. So he uses something called a SMILE framework. So I will just put it here. What does that mean? So that is his style of investing. If you have that level of risk appetite, his style of investing will make sense. But please understand that you are playing the VC game. Do I do that? Yes. A fraction of my portfolio is designed in such a way. For example, I had purchased Zomato, I had purchased UiPath, I had purchased Coinbase. That part of my portfolio follows Mr. Vijay Kedia's style of investing. But majority of my portfolio does not follow that. So you need to contextualize what to pick from every investor. That is what I'm trying to teach you through this video. So what is his viewpoint about the market right now? So he seems to be 100% invested in the market. He has purchased or built his position quite early. He's neither buying, neither selling anything. And yeah, so that's what he's doing, right? So he's just relaxing. He has said that, there is time to be active in the market. Then there is time to be selective in the market. And then there is time to be inactive in the market. So he's somewhat in that inactive stage at this juncture that he's not doing anything. He's just waiting for his seeds to sprout and become like good trees. And then he will think what to do. This story works out greatly for him. For example, if you understand one of his stories, which is called as Cera Sanitary Ware. So that's a stock that he picked when it was at 3.5 rupees or 4 rupees somewhere in 2003. Right now, the stock trades at 8,000 rupees. Now, if you're new to investing, you'll say, yeah, great, right? 3.5 he picked 8,000 right now. It's not as if that he would have picked that stock and slept on it. he would have selectively booked profit. This is something that he says also, that, you know what, I booked profit on that stock. He would have intelligently designed, curtailed his portfolio by hedging his other bets. So how does this entire math moves? So let me give you very quick commentary there. So let's say that he invested like 1 lakh rupee in Cera Sanitaryware in 2003. Okay. Now then there was a bull rally. His 1 lakh became what? 2 lakh rupees. So what he would have done is that he would have booked like 50% profit. He would have kept that 1 lakh rupee. Ki yaar, my principal is sorted. Now let me just keep this 1 lakh rupee intact and let me wait and watch. Then that Cera Sanitaryware kept on going up, up and up. So what that allows you to do is that allows you to witness the downfall and not get pained by it. He himself goes on to say that after every bull run ends, Cera Sanitaryware corrects by 50 to 70%. You cannot stomach that level of volatility unless you have booked some profit. So that is his style of investing. Please pick up that from him. And with that said, let me show you some of the picks that he has made and which are his biggest bets right now. So this is what he has picked this season. So Affordable, Robotics, Atul Auto, Patel Engineering, Precision, Neuraland. He has also sold something called as Ramco or Tejas. There is no point in me doing this stock analysis. Probably I'll make a separate small cap, mid cap video, which you will understand how to analyze small and mid cap stocks. But honestly, what you need to understand from this is the portfolio style of investing. If you're not doing it, you will have a very hard time grasping the entire thing. Overarching viewpoint that Mr. Vijay Kedia holds right now is that he's bullish on infrastructure. For the right reasons. I also feel that credit economy is going to pick from this point. Government spending is going to rise. So a lot of growth will come in banks. A lot of growth will come in retail companies, hotel companies. It might come. So build your stock portfolio intelligently. Even Mr. Vijay Kedia seems to be fully invested in the market right now. If you check his net worth here, you can clearly see that he's sitting on his highest ever net worth as of now. So he's done investing, so to say. He will just wait and watch and see his net worth grow. This is the same style that I am also adopting, almost fully invested. Naya paisa aega, I'll see whether to invest or not. So with this said, I will quickly recap the video and leave you with 4 or 5 key points. Number 1, learn from all investors, develop your own investing style. Number 2, you need to learn how to hedge your portfolio, bring down your risk. Number 3, you will always get contrary commentary from a lot of investors. Do not trust their investing style blindly. If you want to follow my investing style, I teach quite a lot. Write detailed posts, write detailed commentary on member community section. You can check, understand more, right? So that's the entire idea. If you're following Mr. Vijay Kedia, follow his entire style. You will understand, see the pros and cons. Similarly, if you are understanding someone else's investing style, understand the pros and cons. Right now, it's a great time to invest. Almost all the investors seem to be of the viewpoint, you know what, be 100% invested. If you don't want to be 100%, be at least 80-90% invested. That will allow you to cultivate and nurture your portfolio. In case you want to learn how to cultivate your portfolio in mutual funds and how to grow it really big, so I have discussed my 6 CR portfolio on mutual fund here. You can go and check it. You will learn a lot of amazing things on it. Thank you so much for watching and I'll see you soon.